Hi, this is Professor Marsh again, and we are in Principles of Financial Accounting. We are now in Unit 10, and this is the second lecture that's going to look at Chapter 10, which is about inventory. And for this chapter, I asked you to read the entire chapter. I'm going to talk about it briefly. Basically, what Chapter 10 is about is describing and demonstrating the basic inventory valuation methods and their cost flow assumptions, and they can be very different, as we will look at as we get into sections 10.2 and sections 10.3. What we're looking at here is to try to understand the choices that we have in doing accounting for businesses that sell merchandise, that are selling merchandise out of inventory, and how we're going to account for the cost of sales, what we call cost of goods sold, and the ending inventory. And we have a choice basically of four methods. So the first method is to use specific identification. In other words, as we sell items, we're going to try to identify what the purchase price was when we bought the item, so what its cost was to us, and then allocate that cost to the sale. Or we can use an inventory convention, and sometimes the convention that we use is what's called FIFO, which assumes that the oldest units that we have in inventory are being sold first. And wouldn't that seem to make sense, that you would sell the oldest units first? But in periods of rapid inflation, and it looks like we may be entering a period of very substantial inflation once again, oftentimes companies will want to use a different inventory method. They might want to use weighted average as a valuation method in order to blend the costs over the year or over the years that the inventory has been accumulating, so that you don't have wide variations in what your cost of sales is and what your ending inventory is. Or they might want to use LIFO during periods of inflation. Companies that want to lower their income and maybe even predict what their profits will be in the future oftentimes use LIFO, so that they take the highest costing items that were most recently acquired during periods of inflation and use that as their cost of sales. And then they end up with lower cost items remaining in their inventory. So that has the effect of depressing the gross margin, which depresses also net income. And for tax planning purposes, LIFO is oftentimes a method that's attractive to businesses that are more sophisticated about their inventory valuation and their tax planning. So let's look at section 10.1, and you see in section 10.1 the example of Sierra Sports, and you see the inventory that they have on their balance sheet, and then also the cost of goods sold that they're showing in the calculation of gross profits at the top of their income statement. So you can see where those typical balances are and what the inventory number represents. Is the remaining merchandise that the company has that hasn't been sold, and then what the cost of goods sold represents is the cost of the inventory items that were sold, or at least the cost that's allocated under the inventory convention that the company is using. And you also see a discussion of a perpetual versus a periodic inventory method. A periodic inventory method is where the company actually periodically will take account of what inventory is left in their warehouse or in their merchandise stores. And so they will look at what the value is as of a date, and then they'll calculate what beginning inventory was, add purchases to it, subtract out the cost of the inventory that was sold, and end up with ending inventory. And oftentimes what they'll do is they'll figure that equation backwards, and then they'll have beginning inventory plus purchases minus the physical count of ending inventory, and that will determine what cost of sales is. And so that's how we would do that calculation. If we had a perpetual inventory method, which is very common among retailers now, or wholesalers who have sophisticated technology, barcode scanners, they can actually figure which items are being sold and update their inventory in real time, which there's a huge advantage for that in terms of making sure that they have the goods available as the customers need them on the shelves. And so there's that discussion in your materials. And then also a discussion of the specific identification method, the FIFO method, first in, first out, and the LIFO method, last in, first out, for inventory, and then also the weighted average cost method. So that is section 10.1. In section 10.2, I want you to read the examples of what happens with the periodic inventory method. I just described it to you. It was beginning inventory plus purchases, which equals goods available. You take a physical count at the end of the period, find out what your ending inventory is, and then that difference between goods available and ending inventory equals your cost of goods sold. And if you jump ahead, go through the FIFO and LIFO and the weighted average cost method, and look at the comparison of the different costs of goods sold, and you'll see that under the LIFO method you get a much higher cost of goods sold. You get, in the same example with the same numbers using the LIFO method, you have a cost of goods sold of $9,360, whereas under FIFO, assuming that the first in was sold, then under FIFO your cost of goods sold is substantially lower. It's actually 7,200 versus that 9,360 under LIFO. So much more, and certainly a very depressing effect for LIFO on gross profits and overall net income. But that's what people want for tax purposes. So looking at the perpetual method, I'm going to leave you to take a look at that and work your way through the calculations. There is a good comparison of the various methods and the effects that would happen if there was an inventory valuation problem. This is in section 10.4, and when you look at section 10.4, you can see that the error is highlighted in blue, in a shade of light blue, where ending inventory was understated by $1,500. And you can see the effect is for year one that what would otherwise have been net income of about $1,200 becomes a loss of $360. This is the figure 10.23, example number 2, that I'm looking at, that is in section 10.4 of your materials. And then that carries into the next year, in which you begin with ending inventory of that smaller amount, that's $74.55, and then year two's income is going to be overstated by that $1,500 in the second year, assuming that the ending inventory count is accurate. I have to say, when I looked at this example, it looked to me as though it was an example of what is sometimes called by practitioners an inventory cushion. In other words, it's a deliberate undercount by the company of ending inventory in order to increase the cost of goods sold, which if you look at the middle of the presentation of figure 10.23, you can see cost of goods sold in year one, because of the mistake that was made, or perhaps the deliberate inventory cushion created, creates a cost of goods sold in year one of $8,700 on sales of $11,340. But in year two, when it washes out, you have cost of goods sold of only $6,400 on sales of $12,474, and so a gross margin, a gross profit percentage, which in year one, because of the mistake, is only about 30%. In year two, becomes almost 50% as that inventory cushion washes out. And so, if it was intentional, probably when they took ending inventory the second year, they'd also have to create another cushion, or net income would be quite huge. So that's the discussion about that. And then in section 10.5, you can see the calculation of some inventory management ratios, including the inventory turnover ratio. How often in a year do you sell your inventory? And also the days sales and inventory ratio as well. And if you can turn your inventory very, very rapidly, then you don't keep a lot of your working capital tied up in inventory, and it certainly improves your financial performance, and probably also improves your business performance, because if you're also having periodic improvements in your products, and those are coming out in versions 2, version 3, version 4, and differentiating themselves, you don't want to have a lot of old inventory reflecting what the market was like, some year or perhaps a couple of years before. So that's it for chapter 10, which is the second part of unit 10. And next time we'll talk about long-term assets. So with that, good luck on your homework and your quiz, and we'll talk with you again soon. Thanks a lot.